And the reason we do all of this, again, as I mentioned, is not to replace our underwriting, but it's to save us time throughout the day. You can't get a deal and then load it up into a full underwriting model every time you have a deal. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to be talking about 4 back-of-the-napkin underwriting checks that you can use in your business to quickly evaluate deals and to quickly screen deals when you're sent an opportunity by a broker, by another investor, whoever. These are 4 checks that we use all the time in our business, that I'm constantly using myself. And you need to understand these, one, how to use them to quickly look at a deal. But you also need to understand the data that supports how to use these back-of-the-napkin checks. A couple of these are going to be pretty basic and probably repetitive for a lot of the more experienced folks who listen to the podcast. But the other couple that I'm going to discuss, the final 2, might be, I would imagine they're pretty applicable for not only everyone listening, but also a nice reminder for the experienced investors out there that are trying to hone in their skills as it relates to quickly looking at deals and saving time when we're actually going out there and pursuing deals. And that's why we need to understand these, is not as a replacement for doing more in-depth underwriting of a potential deal, but to just save us some time. Right? Oftentimes in real estate, we're being sent a lot of deals by a lot of individuals. Oftentimes those deals are just not going to be worth any time investment, right? And anything above and beyond maybe just a quick email, text reply, something that's like, hey, based on these quick checks, like I know that this isn't really going to work for our underwriting, and here's some quick feedback. And you need to be able to do that so that you're not just spinning your tires and wasting time on a day-to-day basis. So what I'm going to do here is pretend that we're looking at a very simple deal, right? We're looking at a 10-unit deal for $1 million that needs $20,000 in renovations in our market with $1,500 stabilized rents. So those are the big 3 numbers. This is a deal, let's say a broker sends us this deal. And scale up, scale down the numbers. If you're doing big deals, small deals, doesn't really matter. I'm just using this for round numbers. 10-unit deal for $1 million, so $100,000 a unit. The property needs $20,000 per unit in renovation, so $200,000. And the average rents when we're done, let's say they're all the same units, it's going to be $1,500 per unit when we're done. So going to be into this deal for $1.2 million, and we're going to be able to rent each unit for $1,500, which totals $18,000 a month in gross rent that we would be collecting at this building, or excuse me, $15,000 a month. In terms of what we'd be collecting on a monthly basis. So the first thing we do in our business, quick price per unit check. We all understand this, right? And in our markets, I'm not going to use this deal as a price per unit check because every market's very different. I'm sharing the stats here really because it's going to affect us it's going to impact how we discuss the last 2 screening checks that we do. But the first thing I want to talk about is price per unit. Most of the deals that trade within a certain class, within a certain year built, in a given market, in a geographic market, are going to trade in some range from a price per unit standpoint with minimal outliers. And the outliers are typically going to be extremely high or low bedroom counts or significantly improved properties, right? Where there's been a ton of CapEx spent and the next buyer is buying something that is truly stabilized that doesn't need any dollars. But you should understand the range that properties typically trade at within your acquisition criteria. Again, your class, let's say you're doing C class, you're buying stuff built in the 70s and the 80s in a certain geographic market. You should be looking at the trades on a regular basis and understanding where deals trade from a price per unit standpoint. Obviously, rent is going to impact this. Obviously, NOI is going to impact this. Obviously, bedroom count, which fundamentally impacts rent, your expenses and your NOI are going to impact that. But most deals are going to trade kind of within a range. And if you're sent a deal that's got a bunch of 1-bed units and the seller's asking $150,000 a unit, but you know that those properties typically trade at $100,000 a unit, well, you can just provide some quick feedback because you don't have to go and do a full underwriting in a model and waste all of your time doing that. So it's important to track your trades and understand what's going on from a price per unit standpoint. And we'll breeze quickly past that one because most listeners understand that. The second one that gets a little bit more granular is the rents versus the purchase price. Or if you're doing more moderate, heavy value add stuff, rents versus purchase price plus your projected renos. So for example, the deal that I outlined, we're buying it for $1 million. We're putting $200,000 into it. And again, watering it down. We're buying it for $100,000 a unit. We're putting $20,000 a unit in, and it's going to rent for $1,500. That's over the 1% rule, right? That's 1.2% or something along those lines in terms of the percentage of what the rents are on a monthly basis versus what we're paying per unit, or if we were to do the total, right? $15,000 in rent versus $1.2 million in all-in cost. And for, again, we're doing back of the napkin checks, so we're leaving out some of the other costs here, right? Which we would capture in a full underwriting, such as closing costs, all that. But again, we're just trying to do back of the napkin screening here to see if this deal is worth taking a longer look at. In my market, for example, I know that once you start to create a spread between the 1% rule, right, which is the old rule that a lot of investors typically anchor themselves to or used to anchor themselves to as it relates to if you're getting more than 1% of your purchase price in monthly rents, this deal might make sense. Yes, that is very rudimentary, but when you underwrite enough deals in your market and you actually do a full underwriting of a number of deals, again, that are in a kind of a narrow criteria, whatever your acquisition criteria is, you should be able to spot those trends and you should be able to understand what that relationship is between monthly rent for a unit and your monthly all-in cost for that unit. In our market, right, that's a deal that would be worth looking at a little bit further. If we're getting $1,500 a month in rent and we're into this project for 1.2 or $120,000 a unit, it's worth taking a look at that. In your market, it might not be, right? If you're in a very rural part of the Midwest, you might need a bigger spread than that because your market cap rate's higher. If you're in a core market, like a Boston or an LA or whatever, New York City, there's probably going to be a closer gap to that. You might be below the 1% rule in your market. You might be renting units for $3,000 a month. And if you're into it for $375,000 per unit, that might make sense because your cap rates are lower and there's a different relationship there. But you should be underwriting enough deals in your marketplace to understand what that relationship looks like so you can quickly look at a deal and understand if it's something that's going to make sense for you, your criteria and your return requirements. Now is when we start to get into a little bit more of the mathematical quick analysis that gets a little bit more granular. So number 3, quick yield on cost calculation, right? This is something that I am constantly doing. I'm constantly doing this when somebody sends me a deal because this is how we screen a lot of the deals that we buy. We want to underwrite our deals to a yield on cost. That is, again, in terms of how we actually calculate that figure, it's our stabilized net operating income on top of the fraction. Underneath that is our all-in cost. What is the return on all of the dollars that are going into this deal? And I've done countless podcast episodes on this, so just scroll back if you want me to really dive into why this is something that we care about and why it's the most important underwriting criteria that we have. And the most experienced investors I know, they keep coming back to this. The biggest private equity companies, they keep coming back to this. So when we're doing a quick yield on cost calculation, it's very easy. Again, 10 units, $1 million, $200,000 renovation budget, $1,500 per rent and stabilized rents. So let's do some quick math here. And I'm literally doing it on my phone. So we're going to pay $1 million. We're going to put $20,000 per unit into it. So we're into it for $1.2 million or $200,000 into it. So we're into it for $1.2 million. Now we have to quickly calculate our NOI. So we got 1,500 times 10, that's 15,000 a month times 12 months in a year. So we're going to make $180,000 a year. How do we get to our NOI? In our market, we're going to just bundle in our typical operating expense ratio with our vacancy rate. So 45% operating expense ratio with 5% vacancy. So that means half we're losing 5% to vacancy, and 45% to expenses. Our NOI is probably going to be $90,000. So it's nice and easy. We just take our income, we divide it by 2. That's going to be our NOI. So we have $90,000 in NOI. And we're going to divide that by $1.2 million. So our yield on cost is 7.5%. Again, it's going to depend on your market and the market cap rate within your market that determines whether or not that's a good deal or not, right? Let's say we're in a 6 cap market, a market that trades stabilized assets at 6% cap rates. If that is the case, this deal probably has potential, right? We've created a spread between the market cap rate and our yield on cost of 7.5%. That means that we've created value through this whole process. And, we are into this project at 1.2 million and it's going to be worth more. And if we quickly want to understand what it's going to be worth when we're done, and this starts to lead into number 4, we take our stabilized NOI and we divide it by the market cap rate of 0.06. That brings us to 1.5 million, right? If we're into it for 1.2 and it's worth 1.5, that's probably a deal we're going to look at further. And then we're going to start to understand, okay, so what are the closing costs? What are going to be, what are the average rents right now? How much rent are we going to be losing in terms of the difference between our current rents and the stabilized rents through the whole process of doing the value add? What's our debt cost? All of this stuff. That's when we get into all of that. But this means that it's probably worth taking a deeper look at. Now, number 4 is just a slightly different flavor of how to achieve what we just did with our yield on cost calculation. This is what we'll call our all-in cost versus our stabilized value. So again, we know we're going to be into this for a 1-2. All right, $1 million to buy it. We know we're going to need 220,000 a unit. We're going to be into it for a 1-2. What's it going to be worth when we're done? So here we're not calculating our yield on cost, but we're just calculating the stabilized value and comparing it to what we're into it for. And we basically just did this calculation. We know we're going to get $180,000 a year in rent. We know half of that's going to go out the door to vacancy and expenses. Cool. We got $90,000 in NOI divided by 0.06, which is the market cap rate in this market. So it's going to be worth 1.5 when we're done. And if we're into it for 1.2, yes, it's probably worth taking a deeper look at, right? If we want to understand the percentage ARV, that's another calculation that we can do here. And that's basically just, trying to figure out what percentage of the after repair value that we're in at. Now, again, I don't necessarily care about that. That's not something that we underwrite to in our business. But, if you just take 1.5, right, and you just quickly multiply that by 0.8, let's say you want to be in at 20 or at 80% of the stabilized value, that comes out to 1.2, right? And that's a quick check. All right, well, if we're in at 80%, is it higher or lower than my all-in cost? Then you start to understand a little bit more about where you got to be as well. The difference is you could take, the other way to get there, you take the equity that you're creating, $300,000, and you divide it by your stabilized value, right? So 300,000 divided by 1.5, that gets you to 20%, right? So we're basically in at 20% below market value. In my business, in our worlds, that's a good deal. That's a deal we'll do every day of the week. Now we might need to buy it for a little bit less than $1 million because we're not going to have some closing costs, or we're going to have transfer taxes, and we're going to have to pay the debt costs at closing, et cetera, et cetera. Maybe we got to be in at like 950, 960, but we know that this is a deal that's worth looking at further. And the reason we do all of this, again, as I mentioned, is not to replace our underwriting, but it's to save us time throughout the day, right? You can't get a deal and then load it up into a full underwriting model every time you have a deal. When you're new, you do have to do that, right? But as you do that, you should be taking notes. Okay, in this market, every time I underwrite these deals at like 150,000 per unit with, typically with 2-bedroom units, the rent for this, it just doesn't really make sense. The price per unit range we got to be in is going to be a little bit lower. It's probably going to be in this range. I know that if we're going to be into a project at this dollar amount per unit, we're going to need average rents of this in order for that to make sense. These are things that you'll start to develop some level of an intuition around after you underwrite a lot of deals, and then you can just run them through this screening criteria. My personal favorite is the yield on cost calculation because that is the underwriting that we do, right? I'm just getting there a little bit faster by doing it on my iPhone calculator versus doing it in an Excel sheet. And then the only thing I need to do above and beyond that is to incorporate some of the other components of the deal, right? Which would be transfer taxes, debt costs, the average rents, and the delta between what our rents are now and where they're going to be and how much rent we're leaving on the table throughout the stabilization period, which obviously we want to be compensated for. But you're basically getting 60, 70% of the way there with what we just did. So this episode was a little bit more geared towards the beginners out there. But for those of you that took something away from this, if you learned something, please consider leaving the podcast a rating and a review. We're coming up on almost 300 reviews here. It'd be nice to get to that number in the next 30, 45 days or so. Would be a huge milestone. That's really going to put us kind of in the top 0.1% of real estate podcasts if we get to 300 ratings. So good push to get there. And if you're someone who's listened for a long time and you've learned anything on this podcast and you haven't yet, I'll ask you to take 5 seconds and do that if you have that time, which I can't imagine you wouldn't, let's be honest. So long story short, 4 underwriting checks that you should be able to use in your business to look at deals a little bit more quickly, a little bit more efficiently. And my final request for all of you out there, if you have left a review, you have left a rating, and you want to keep helping me out, feel free to share this episode with somebody in your network that you think might value this content, and let them know about the podcast, right? Hopefully they can subscribe and we can continue growing the show. But as always, thank you for listening, and I'll catch you guys on the next episode.